Jamie Sumner, Chief Analyst, Sea Freedom Brew. For this week's webcast, we want to review the fourth quarter GDP release that came out last Friday. And as you know, this is the advanced release. And the GDP came out at 1.9% for the fourth quarter 2016. A little below where we saw the estimates coming in at around 2.2%. So showing a little bit of softening in here, more so than they anticipated for the fourth quarter. But let's look at the individual components of the GDP to see where the softness had occurred. And first we want to look at the overall GDP though, and we can see where we are in the fourth quarter here at this 1.9% compared to last quarter at 3.5. And we look at the different contributing components here with the consumer spending, investment, government, and the net exports. You can see 170 basis points contributed from the consumer segment. Now that's below what we saw last quarter, where it was 203 basis points. We saw this little softening inside that consumer segment. However, the investments made up a lot of the difference, where we see the 167 basis points built into this 1.9% GDP. That's significantly higher than we saw last quarter at just 50 basis points. And we compare that to the prior quarters where it was actually negative for the investments. So we saw this big upswing in investments. Now investments, as you know, includes those inventories. And inventories contributed about 100 basis points. So that was one of the pivotal factors in this big investment increase. Now the question is, going into the first quarter here in 2017, have businesses built up their inventories already? And then we're going to see a pull off in those inventory purchases throughout 2017. So that's still, we're going to still see that as we move along here. My assumption is because of the softness in the consumer segment that we might see that roll into the first quarter and show a lower GDP in the first quarter. But also a highlight though, with inside that investment is the fact that the residential fixed investment picked up, whereas it was negative the past 2 quarters. So that's a pretty big positive in my mind for that investment section. Government contributed 21 basis points, a little higher than we saw last quarter when it was 14 basis points. Big change here was that net exports. The exports minus imports contributed, you can see, took away 170 basis points because of a lot of imports that flowed into the United States compared to last quarter when it was 85 basis points but at a positive. So the net change is pretty significant, over 200 basis points. So overall, we see just softness in the consumer segment, which has been moving along here little by little. The investments are propped up by those inventory numbers. The government spending has stayed relatively the same, and then the exports, net exports here, taking away that 170 basis points because all the imports that we saw flow into our economy last quarter. Now, when we look at the inventories and the net exports, those are pretty volatile numbers. So we'd like to back those out of the numbers overall to get what we call the final sales to domestic purchases. So this gives you more of a domestic look at how the GDP is faring. And as you can see, back in the first quarter of 2016, it was fairly low at that 1.2%. The second quarter picked up a little to 2.4%, third quarter at a 2.1%, and the fourth quarter at a 2.5%. So we see some continued strength in here, and that's a positive when we look at these numbers backing out the inventories and the net exports. So domestically, it seems like we're still pretty strong in moving our way through this expansion here. When we look at finally the inflation numbers, the core PCE You can see back in the first quarter of 2016, we were up at a 2.1. However, every quarter since then, we've been slowly coming down. We're at a 1.8 in the second quarter 2016, a 1.7 in the third quarter, and now here in the fourth quarter with this advanced release coming at a 1.3. So we see this continual downward momentum here. Now, you know the Federal Reserve has set this target at about 2%. So the question is will this need to get back up to that 2% level before they start really tightening at a faster pace in here? And this is suggesting right now they're not going to tighten over the next quarter. We'll talk a little bit more about that later this month. So this is where we have it today. We're going to end here. Next week, we're going to look at the new Federal Reserve Bank of Philadelphia maps, both the coincident index and the leading index next week. Have a great week, everyone.